Parking. God.
All right, team. Welcome to another Learning About Loans with me, the great Justin Wood. Justin, what are we talking about today? What's the topic?
The topic is we're talking about jumbo financing, so jumbo mortgage loans.
Jumbo mortgage loans. So, what is a jumbo? What's a jumbo loan?
A jumbo loan is any loan amount that is over the conforming loan limit for Fannie Mae and Freddie Mac, which for us in this area, $806,500.
So, at the time of this taping, early 2025, it's 806, comma 650. Is that what I just heard?
It should 806,500.
806, I was way off. The 650 was last year's. It was a different number in the beginning, but 805, comma 500 for Texas, North Texas. That is the conforming loan limit. So what does it mean to be a conforming loan, Justin? You said some buzzwords earlier, Fannie Mae, Freddie Mac, but what is the difference between conforming and jumbo? So let's go with, what is a conforming loan? What does it mean to be 806 and under?
Great question. So that's the conventional financing. Conventional has a couple of subsidiaries, Fannie Mae and Freddie Mac, and that's the amount, the loan limits that they set every year to be eligible for conventional plain vanilla financing when it comes to mortgages.
That's the word I was looking for, plain vanilla. So when you see advertisements or the rate scroll across CNBC, when you see buzzwords and things, conventional financing, in this case, conforming financing, it just means that's the plain vanilla Fannie Mae, Freddie Mac. That's what's deemed a quote normal mortgage, right? So just to be very clear, there are two buckets in the mortgage world. So we're going to kind of step back for a second. There is the government loans, and then there's non-government loans. The non-government loans are the conventional bucket. Conforming falls under that. And that's what Justin and I are talking about today. And that's where if you're above the conforming loan amount, which can and does often change annually. So once a year, Fannie and Freddie come out at the end of the year, say, here's what it is for next year. That's what Justin just pointed out. That is a conforming loan amount. And so if your loan amount is now above that number, especially in Texas, above that 806, 500, that is jumbo financing. So Justin, give me some, what does jumbo mean? Like, give me some background as far as what does it mean to be a jumbo loan? Like what are some of the characteristics, and what does it mean for a home buyer that, or even refinance person? What's it mean to be a jumbo loan?
Great question. So a jumbo loan is going to fall. It's normally these homes that are priced in, since it's about 800,000, it's normally homes that are going to be priced at like 1 million plus, right? So that's when you got 20% down, which most jumbo investors require, 20% down payment. If you're at a million plus price point, odds are you're going to be in a jumbo product or a jumbo sort of product where the loan amount is greater than that $800,000 threshold.
Yep. So that 806, 500, that's your loan amount. So if you borrow 806, 500, you're under the conforming, air quotes, the vanilla type stuff. And that's where Fannie Mae, Freddie Mac, and it's easy peasy. You go to 806, 501, and you're now jumbo financing. And that's the reason why Justin says the $1,000,000 or more is because, again, the bigger the sales price, a lot of times folks aren't putting down money to get below that 806, 500. So what does it mean to be a jumbo? So somebody buys $1,000,000 home. Let's say they buy 1,500,000 just for grins. They buy 1,500,000 home. They put down 20%. So in this example, that's $300,000. So they're going to finance a jumbo loan of 1.2 in our example. What does it mean? If I'm getting a loan amount for 1.2 million, I'm in the jumbo because I'm above that 806, 500. What does that mean in terms of just doing the mortgage and qualifying for the mortgage?
Yeah. So with the jumbo programs or a lot of those higher loan amounts, it typically means more paperwork, right? A little bit more,
It does.
a little bit more research and things that you wouldn't normally need for like a conforming or conventional product, like tax returns, right? Or maybe additional reserves for that new loan. The jumbo investors are going to ask for usually 2 years of tax returns. And they're also going to ask for additional reserves, whether it's retirement, 401k, brokerage accounts, just to make sure that, all else fails and something happens, you have some more ability to repay than what the securities would allow for like a Fannie Mae or a conventional plain vanilla file.
So who are these investors? So I think that's really important to hit on because Fannie Mae and Freddie Mac, they're quasi government owned, quasi, government regulated entities that were created long, long ago to help the mortgage world. And Fannie and Freddie kind of set the here's what's needed, and lenders follow the Fannie and Freddie guidelines. So if Fannie and Freddie aren't doing this, who are? Like, give some examples of investors. You say the jumbo investors. What does that mean?
Great question. Traditionally, most of the time with jumbos, it's banks. Now, each bank is set up a little bit differently, and some will actually partner with local lenders like us just to have an agreement on what kind of pricing they can offer. But more often than not, jumbo-backed securities or loan amounts greater than 806,000 are going to be insured by the banks. Thus, if it's the bank's money, there's a little bit more requirements for paperwork that they're going to require because now the risk falls on the bank to approve it and finance your loan, not just the agencies that have other protections built in with lenders like conventional or FH or Fannie Mae or Freddie Mac.
Yeah. So again, to be very clear and repeat what he said, but just said differently, with Fannie Mae and Freddie Mac, it's like here's the rules, and the mortgage industry can underwrite to those rules. Like go to lender A, lender B, lender C. They're all going to have the same because Fannie and Freddie, they're the the governing body for that agency. You go to jumbo, to what Justin just said, it's people like not people, it's institutions, Bank of America, Wells Fargo, Chase, Goldman Sachs, and then a bunch of other names you don't even know because they're not traditional banks. They purchasers of jumbo loans. So there is a ton. I mean, there's small banks, there's big banks, there's middle banks. And what makes it hard, to Justin's point, each one is going to have different set of requirements of what they need or want. So where one bank might say, man, we're really tough and we want this, another bank may say, we don't care as much and it's no big deal. So Justin, how do you pick? So if somebody comes to you and wants to a jumbo loan, buying, the 1.5 million example we used, how do you determine which investor to go to?
That's going to come down to the things that are unique to the buyer, right? So what's your exact credit score? What's your DTI look like? How's your income structure? How many reserves do you have? What kind of down payment do you have to put together? And the nice part is too, people are like, well, some will counter, I just want your rate, right? It's a jumbo product. I just want your rate. Cool. But if you can narrow the scope of those things, the competitive advantage is that there are so many investors who may be after, how you fit in their bucket. If you're at 800 plus FICO, got 36 months reserves, got 20 to 25 to 30% down, an extra down payment, more often than not, investors with those jumbo backed securities, they'll offer better rates and incentives to get that kind of client because that's the one that they want.
Yep. Sorry to interrupt, but I think that's really important to get the better rate. So Fannie and Freddie, once you qualify, you qualify. Like, I don't care if you got $5 million sitting in a bank account or $5,000. If $5,000 all that's needed to qualify, you qualify and that's your rate. Unlike jumbo, what Justin just said is so important. With jumbo, everything can matter as far as qualifying with an investor. And this investor may have better rates than this investor. And you would think the answer is not just go with the lowest rate. Justin, I'm sorry to cut you off. You were saying how when you go shop, air quotes, shopping, right? So our company, the way companies are structured is, we put stuff in and it feeds it in and we work with it. So how do you pick the investor ultimately? So now you've got all this information, you got the data, the credit score, the assets, the income, you got all this stuff. How do you pick which one?
Yeah, once we have all the documentation in, we'll pick which investors they qualify with, right? And then we'll pick the best rate out of those buckets. So we've narrowed that funnel from here's all the jumbo products to here's the products you qualify for to who has the best terms for what you're trying to accomplish.
When would you not give somebody the best rate? So in other words, and we'll see if you can read my mind. I got the answer, so I got you. If you don't read my mind, that's okay. Give me what would be an example where somebody may be able to get the best rate, but we with the buyer or with the borrower, if they're refinancing, we may not choose the lowest rate. Give me an example without saying any names. Why might you not go with the lower rate when possible?
Well, oftentimes what we find is that the lowest rate with the wrong strategy costs a lot more money than a competitive rate for the strategy you're looking to pursue. Some of these jumbo investors may have prepayment penalties. Some of them maybe, it costs you like a point or two to even get that lower interest rate. And ultimately, like with a lot of our clients, and like you said, we're filming this in early 2025. A lot of our strategy right now is built on how long are you going to live in the home and what's your target strike rate for a refinance strategy? Because more often than not, paying a point, which with the jumbo loan, right? That's 10 grand for $1 million loan amount.
Mhm.
So does that 10 grand really benefit you for your savings and your payback window to save 0.5% on the rate? Maybe, maybe not, right? So that's really what it comes down to.
And I will tell you, you're really good at running the numbers, right? So that's part where you and I have a lot of the nerdness come out, and not it doesn't necessarily resonate with everyone, but I agree. Like the strategy can matter more than just the rate. And if this lender has a low rate, but they're going to charge a point to get it or whatever it may be, you might choose something else. The one I was thinking of, so I didn't think of that. That's absolutely true, and we do that based on just the cycle in the market because that's not a universal flat strategy. It's based on the person, based on the home, most importantly, based on today's market and where we think it's going to be in 12 to 24 months. I think another one could be that I know when we talk to borrowers, if it's a 3-week closing, right? And somebody says, man, I got to do this. Or if the borrower is self-employed and it's all this stuff, and technically they do qualify for going with investor X. I'll say, I don't want to get sued. So but it's a big bank. Everybody knows them. My God, I'll do everything I can to avoid going to investor X. And I tell the borrower, hey, Mr. Smith, here's the deal. Your rate could be this, right? And it's going to be the lowest rate. And it's the one that if you see it on TV or somebody else told you they can get it, here's what it is. I don't like this option because they've proven over and over and over that they cannot execute. They cannot get this done in the quick time frame that we have. What do you want to do? Unfortunately, it happens where borrowers are like, I still want it. Let's do it. And then they're mad when it's either a sloppy closing or it's a delayed closing for a week or 2 weeks or whatever it is. Because again, understand with jumbo, even if you go straight to said bank, right? I promise that's not going to be any better than us. I mean, at least with us, they're trying to earn the business. Justin, and let's see if you and I would answer the same way. And you can say pass and have it come back to me if you want. Let's just pick bank X, big bank X, one you know of, doesn't matter. What if somebody says, well, I'll just go straight to bank X. And in theory, I think I'm gonna get a better rate. True or not true? And why is it true or not true?
It it depends, right? As far as both, I will say pass. It could be true, right? Depending on maybe how their assets or holdings are with big bank X, right? Maybe they qualify for this portfolio per whatever it might be, or some excuse for whatever personal banker. The difference is though, is that usually more often than not, the personal banker doesn't have the experience to be able to give you that good pre-approval or pre-qualification because quite frankly, that maybe they've never seen a business tax return, or maybe they've never reviewed those things. And that's not to discount whoever's in that bank or that local branch, but you're not dealing with the expert. You're dealing with whoever in the call center for bank X just happens to have the least amount of calls in their queue that day.
And so you read my mind. So guys, the answer is it could be true, could be false. And here's why what Justin said, if it's the typical, and again, no disrespect, right? But if it's the typical banker who happens to do mortgages, one, the experience, but two, I would argue that we're probably going to be better in rate more often than not. And here's why. And it's not just our company, right? It's not just Justin and Mark. It's as an industry, if big bank X is loaning out private money or jumbo money, when we do it, when Justin and I do a loan, our company, including us, we're on the hook for delivering a high quality, damn near perfect loan. And we have to give it to big company X. And if big company X ultimately finds something they don't like with it, or, and this is no joke, 6 months later, the borrower misses one payment and they end up catching up, but they just were late on a payment, they can hit our company for money. Or they can just say, we don't want it, give it back, give us back all our money and a penalty. So there's way less risk for them when we originate it versus if said bank teller originates it, they are then on the hook. There's nobody to push it back to. They are that company. So when people say, I want to go straight to bank X, the exceptions, not often, but the exceptions when they will get a better rate is what Justin said. When you got a lot of, if you got $3 million, $5 million sitting over there in an account, they may put you in the private banking sector, which is different than the normal. And absolutely, we'll be the first to tell you, hey man, if you got that kind of money, let's go shop them first. We will check. And if we can't win, like no harm, no foul, right? At the end of the day, and that's the benefit of having the ability that we do is to go to a bunch of different investors. Sure, that may be lower than bank X, their private banking's lower, but maybe bank Y that we have access to could be lower. So that was a loaded question. Justin, let's talk about the important part, rate. Is rate higher or lower with jumbo loans?
In today's market, as we're reporting it with 2025, it does depend. I can tell you though, sometimes jumbo rates are actually more competitive than what's going on in the normal marketplace, and could be for different reasons. Could be for, this is more capital market stuff, but without going too far down the rabbit hole, if Fannie Mae, the conventional, normal, non-jumbo paper, if these bondholders are anticipating, this loan to be refinanced as soon as rates drop 0.5%, maybe the rate or the cost to originate that mortgage is a little higher. Thus, the rate for normal conventional stuff, it may be higher than jumbo rates right now. Traditionally speaking, in a normal market, jumbo rates can be better. They can be a little bit higher. At this moment in time, there are many jumbo investors, though, that are willing to offer better than your normal plain vanilla market interest rates. And that's with the standard 30-year fixed. Sometimes, an ARM will pop up every now and then, which we can talk about later on another video, where the ARM rate's actually better too. And again, they're going after that specific buyer that meets that credit profile, reserves, all those things that go into their, reasoning to originate and offer that lower rate, because they want that portfolio of that buyers for them to operate on too.
Yeah, Justin's answer is exactly right. It depends, right? So I gave him another question that doesn't have a definitive answer. Sometimes jumbo rates can be lower. Sometimes I would say, generically speaking, normal market jumbo rates are going to be a little higher than conforming. That's the normal market. But to Justin's point, if a bank needs money, or needs loans, or needs, they have certain bank charters that where they have to fill a certain percentage of their assets into real estate, or they just got the faucet turned on, or they need and want this, they'll turn it on and go get it. So it can be where big company X is super, it's the flavor of the month, and then they get full, and all of a sudden next month their rates are significantly higher because they're trying to turn off the faucet. So rates, I would say, generically speaking, can be a touch higher. And you say, what's a touch? Look, in a normal market, I could see them being a quarter to half point higher than normal. But they can also be a quarter better, right? I don't know that they'll ever be a half point better than conforming. But at the end of the day, jumbo rates, generically speaking, I'd say, 5.1 times out of 10, right? They're typically going to be a little higher, but it can be both depending on the market. Cost, Justin, I think the answer is we both know it, so we'll just get to the chase. Cost-wise, it's about the same, right? There's no real difference. You and I do a loan. It's loan's a loan. Rate's important. Obviously, we talked about strategy. Underwriting, they're going to be more strict. Some are going to say, like, here's what we allow, don't allow. Generically speaking, you've already mentioned it, 20% down for down payment. Credit is much more, heavily weighted to where it's like you're probably not going to get jumbo financing with low to marginal credit. What else am I forgetting? Anything else out there that we forgot to hit on?
Yeah, the cost aspect, I think that is important, because for us, with being a direct lender and having access to these jumbo partners, the contact I use is that whether my loan amount's $100,000 or $2.5 million, right? Our lender fee is the exact same across the board, right? It's not a percentage of the loan amount. That's our fixed cost. So really the only variables would be, title policy, which we'll talk about later, things like that. But for us, it's nice because we don't charge higher fees to originate, these loan amounts that may be higher in the jumbo category. And a lot of it's third party, like title, escrow, things like that are not that. So that is a neat part too. I just wanted to add.
Yeah, it's a really good point. Your title policy, because you're financing more, that's set by the state, not us. The state, the Texas Department of Insurance sets that amount. Your appraisal might be a little more for bigger square footage, but for the most part, the fees are the fees, especially when it comes to us. A loan's a loan, whether it's a 600,000 or 6 million, right? Or 60,000, a loan's a loan to some degree. So I think that's, if you do want to check out, like, oh, how can I avoid jumbo financing? We're not going to get into it here. Second liens, we don't see many of those in today's world. They are possible. Can you do less than 20% down? Maybe. Is there a way in other states, not Texas, high balance, conforming high balance? So there's ways where you go above that 806, 500 number. Again, in 2025, that's the number. There are ways where you go above that. And if doing so, you can have a high balance loan, not in Texas, but there are states like California that exist. So I think that, J-Dub, I think we hit the highlights. Anything else for parting stories or comments?
Yeah, just like we always talk about often, get pre-approved early, get your documents in so you have every single option available to you, and you're not just twiddling your thumbs wondering, what do I do next, right?
More than ever, guys, what he just said, get your documents in. Help us help you. Too many times we see people sitting on their hands, and you can kind of get away with it for the plain vanilla stuff. You got it. You got to execute your job. We will do ours, I promise, but you got to do yours. That is so smart. All right, team. Well, thank you for joining us again on another Learning About Loans. Justin, you're amazing. I appreciate you, and we'll see you guys on the next episode.